All right, good evening, everyone. Again, welcome to our Long Beach Homebuyer Workshop. My name is Jason Mata. It's great to be with you this evening. This is an interactive session that we teach every couple of weeks here, and we're doing this exclusively for, not necessarily exclusively, but in partnership with our Long Beach alumni partnership. So really great to be with you. As I mentioned earlier, this is going to be an interactive session. So as we move through tonight's content, we really encourage you to ask us questions. Some of those questions we'll go ahead and bring to the larger group and kind of cover those as part of our material this evening. So our session should run just about an hour, may go over a little bit longer than that, just based upon questions that we get from our audience this evening. Okay. All right. Well, let's go ahead and dive in, and we'll go ahead and get our slideshow running here. Just a little bit about me. I'm the branch manager for American Pacific Mortgage. I serve in California as well as in the Arizona markets. And we're really kind of more on specialty around first-time home buyers and assistance with kind of supporting and providing resources around first-time home buying. So that's obviously why you're attending a workshop such as this. And we specialize in the Cal HFA assistance program, which you're going to learn a little bit more about this evening. We do offer a full wide swath of products, including conventional loans, FHA loans, VA, USDA, and like I said, the Cal HFA products. So we'll talk more about those in tonight's discussion, but we will spend most of tonight's conversation really looking at how do we help and support first-time home buyers on this journey towards home ownership. And now, as part of the partnership, as you probably, or that you heard a little bit earlier, so we work in partnership with Long Beach State alumni. We also provide a discount in that partnership. So it allows buyers or even clients that are refinancing a $750 closing cost discount. So that's for our alumni, employees of Long Beach State. If you're joining us through one of our other partnerships through USC, UCI, UC Riverside, Davis, Arizona, and we just added on VCU, you would also be entitled to those that discount program as well. So we'll talk more about that a little bit later in tonight's discussion, but want to kind of share that with you. So a lot of cool things that we try to add to some of our partners. And let's talk a little bit about tonight's talking points. And we're going to spend some time looking at the housing market. Lots to talk about there, especially even though we're kind of in the winter home buying season. Still a lot of activity in the housing markets all across California and some of the West Coast markets. Then we're going to kind of transition into does buying make sense? We're going to take a look at a rent versus buying calculator. We'll also spend some time looking at credit and how you can optimize your credit to put you in the best possible position for home buying. We'll talk about student loans and how does that maybe impact qualifying. So for those of you that do have student loans, how we can maybe take a look at those monthly payments and how that's going to be factored in to your qualifying. Then we'll look at loan programs, spend some time looking at the minimum down payments. There's been some recent updates with the maximum loan amounts for loan programs. So I'll spend some time sharing that with you this evening. So that's really a good time to talk about that. We'll also look at qualifying income, some of the documentation you'll need as a buyer. And then we'll look at down payment assistance programs. And we work in conjunction with an organization called Cal HFA. It's the California Housing Finance Agency. So I'll share with you a little bit about the assistance programs. And then we'll wrap up tonight's discussion looking at the process of buying. We call it our 6 steps of home buying. So what does it look like to be a future home buyer at pre-approval all the way to when I get my keys for my home purchase? And then finally, we'll talk a little bit about our consultation and really kind of what a pre-approval might look like for you. Okay. And of course, as I mentioned earlier, we're going to make this an interactive session. So as things come up that maybe spark a question for you, we'll definitely bring that back to the larger group. Okay. So when we think about purchasing a home, it's probably going to be, really one of the largest investments or financial decisions we make in our lifetime, right? So this isn't like switching from one apartment to the next or making a car purchase. This is going to be a big deal, right? And with buying, there comes some really great benefits with owning a home. The ability to create stability or affordability in your housing payment. This is an asset, so the ability to be able to pass along that asset to the heirs of your estate. With growth or the growth in value of your home creates equity. Home equity is based upon how much you owe on a house versus what the value of the home is. And there still remains some tax benefits with home buying. So potentially you can deduct the interest that you pay on a mortgage. So a lot of great things that come with ownership. Now, I talked to you earlier about our calculator that we're going to look at. So we're going to talk a little bit about affordability, doing some comparisons to where does that look like where I'm currently at from a rental perspective versus what it could look like as a buying standpoint. So we're going to go ahead and jump into this calculator, and we'll screen share this with you. We're going to walk through with just a scenario, typical scenario. So as we're thinking about home ownership, we're going to look at our budget, right? And we're going to compare that rental budget where we're at today versus what it could look like with home ownership. Are we good on our screen share? Yeah. Okay. All right. So let's take a look at this example we have. And by the way, this is a calculator that's on the Freddie Mac website. And all of the material, all the links that you're going to see this evening, we're going to share all those with you. So tomorrow morning, you'll get our slideshow. You can also rewatch our video. You'll see it on YouTube as well, or you can share that information with friends and family as well if they want to check it out. So let's look at this scenario here. So this scenario, we're looking at a rent situation of $2,500 per month. We're also going to assume monthly renters insurance of $15 per month. So most of us probably have that if we're currently renting. And then when we look at potential rent increase, we're going to assume 3%. Now, generally, at the end of your lease period, your landlord's probably going to ask for a higher level of rent. Sometimes that's not the case, but generally the rent will go up at the end of the lease period. And then let's go ahead and make some assumptions around the home purchase. In this case, we put $500,000 as a purchase price. That will really be determined by where you look in, assuming you're looking in California market. So whether you're looking in Long Beach, or maybe you're going down into Irvine or San Bernardino or Riverside, those purchase prices will look different based upon the type of property you're looking to purchase. But let's assume for this exercise that we're going to purchase at $500,000. The minimum down payment would be 3% or $15,000. We're going to talk about minimum down payments in just a bit. Property taxes. Generally, your tax rate on a home is going to be anywhere between 1.1 to 1.25% of the purchase price. So that's our assumption here in annual taxes. We're also going to assume $1,000 a year for homeowners insurance. That insures the structure of the home and the contents. And then we're also going to factor in maintenance. In this scenario, we have $2,000 set aside for maintenance. So obviously, something goes wrong with our house, we can't call the landlord and say, hey, we've got to fix this hot water heater, whatever the case may be. We're going to have to outlay that as an expense for us with our new home. And then we're going to click on this tab here, loan information. So generally, as a first-time buyer, we're going to be doing a 30-year fixed mortgage. And then interest rates, we're going to put at 3.25%. I'm going to spend some time talking to you about interest rates in just a bit, but for this scenario, let's put in 3.25. Origination charges, that's generally what your lending costs will be. And as you heard earlier, as part of our partnership with Long Beach State, you do have your $750 discount. Then with financing, you have an option of what we call as discount points. And discount points allows you to basically buy down your interest rate to a lower level. So let's say at 3.25%, I'm paying no discount points, but let's say I really want a 3% interest rate. Well, generally 1% in additional cost of your loan amount will equate to a 0.25% reduction in interest rate. So let's say I pay 1% of my loan amount, which in essence would be about $4,850, so $4,850. If I paid that in additional closing costs, that would potentially lower my interest rate to 3%. And that's what is called is discount points. And then these other settlement services is going to be all inclusive of all the closing costs in purchasing a home. And we'll talk more about assets and what we need to do to save enough money for our home purchase. But ultimately, we're going to need to save our down payment, which in this scenario is 3% or $15,000, plus we'll need help with closing costs. And closing costs are generally 2 to 3% of our sales price. And that's where we come up with these numbers here. Okay. Now, the last tab is the other assumptions we'll make in this calculator is around appreciation. So we talked about home equity just a minute ago. So as the home appreciates, if it appreciates 3% per year, so we're looking at $15,000 in appreciation in the first year. That could be higher or lower depending on where we're buying, but hopefully we're appreciating. We're also going to add in expected years in the home, which we put 7 years here. Cost of selling a house. So as a future home buyer, when you're buying a house, the cost that is paid towards a realtor for the commissions is not paid for by the buyer. It's actually paid for by the seller. Now, in 7 years, when we decide to sell this house, we're going to have to pay those costs to the seller to the listing agent. it's going to represent us as a seller. And so with that, and you also would be responsible for paying the commissions to a realtor once you sell your home. So we want to factor all those costs into about 10%. The other two components are state and federal tax rate of 33.8 and then savings rate of 1%. So what this calculator does, it says, okay, well, let's go up here and we'll look at payments. So if our payment on our rent is at $2,515 or $2,500-ish versus our mortgage payment, which is going to be about $800 higher at $3,300 per month. If I was to look over the next 7 years and my total cost of renting would be about a little over $220,000 in rent payments that I would make over the 7 years versus my total cost of owning when I take into consideration my equity appreciation and my tax benefits, that was about a $97,000 opportunity over 7 years. So if I compare my total rent costs versus my total outlay and payments on my mortgage, and then factor in equity appreciation and tax benefits, that's where we come up with about a $97,000 opportunity. Now, it's not always the case for everyone with that type of scenario. Certainly, if you have a lower rent payment, then you're not going to have as much upside because it might make sense for you to continue to rent. But that's an exercise that it's generally pretty helpful for first-time home buyers just to figure out, does buying really make sense for us? Now, as part of a consultation, if you decide to take that next step in kind of discussing options with us, we'll go and get a chance to do that affordability analysis together as well. Okay. All right. So that's the Freddie Mac rent versus buying calculator. Okay. Good. All right, we shared a little bit about housing appreciation when we factored in our buying versus rent calculator. And now let's kind of look at what housing appreciation looks like right now. And so this chart here kind of shows you since late 80s what housing appreciations look like. Now we're all pretty familiar about what happened here in this gray bar here, which is the downturn in the housing market. So in 2008, we saw the decline in the housing market. We saw defaults at all-time highs. Much of it attributed to what we saw going on here, which is deceptive lending practices, just things not putting people in a position to succeed with home ownership. And of course, we saw the correction with interest rates adjusting, unfortunately, people buying beyond their means. And so ultimately, we see the housing crash here. Now we see the recovery here in 2010 and a nice little, kind of move upwards with appreciation. And then really, once we hit pandemic numbers here in 2020, March of 2020, we even saw just a rapid incline in appreciation in homes. Much of that attributed to limited inventory. So sellers concerned about selling their homes in the middle of a pandemic. And then you have this huge demand on the buyer side of buyers deciding, well, maybe I don't want to live in more of a densely populated area. Maybe I want to go and push further out to San Bernardino or Riverside. Or I'm working from home now and I really want to own something. And so we see this huge demand that came into the markets, pushing up the ultimate price of a home because we had limited supply, high demand, and just pushing those prices up. Now, the market has slowed a little bit. We're still in a super competitive market. If we were to look back in our spring and summer buying months, we would see some buyers that were competing with 20, 30 offers on one home. That slowed a little bit. Now we're probably, depending on the market, 5 to 10 offers on one home. But there still is a lot of interest in home buying. For those of you that are joining us this evening, you're probably kind of putting together your 2022 plan for home buying or maybe 2023. So now's a great time to kind of really sit back and kind of get this all figured out. So if it is on your game plan for the upcoming year, you can kind of see, what it will take to get you to that next step. So when we look at the housing market today, home values are high, but we also have a low interest rate environment. And we're going to look at interest rates in just a bit, but your average interest rate is bouncing around between 3.1 to 3.25. So interest rates are still at great levels. They're not at, I guess, late pandemic levels, which we saw rates hit 2.625, which you'll see a chart here on that in just a second. But ultimately, that is helping fuel some of what's going on in the housing market. The other question we get quite often is there going to be a housing bubble? And some people have kind of remained on the sidelines of home buying because they're waiting for the market to just crash. The market looks so much different than it did in 2008 in terms of what we have from an inventory perspective. We have a lack of new construction. We still need more new homes. And of course, the lending environment looks completely different. We have clients that are truly fully qualified. There's not these kind of niche products that are going on in the market. And so that is creating more stability in the housing market. So we're not forecasting any type of housing bubble. Will we potentially see a slowdown? Perhaps, but we're not going to see depreciation from what we're gathering. We're seeing some softening right now, and I think much of it's attributed to sellers that were probably a little bit overzealous with the offer price or the sales price that they put out in the market, and now they're realizing that maybe they can't get that top dollar that they were expecting because maybe it's not as comparable to maybe their neighbor's house that sold for top dollar. The other thing to just keep in mind when we look at the market is just comparing 2006 versus 2021 in 2021, I should say, as it relates to affordability. So if we look back at 2006, the average home price nationally was $210,000, but the interest rates were double what they are today. So they're about 6%. Average mortgage payment was $1,259. Of course, you can see the median income. So, the percentage of income for a mortgage payment was about 26%. Now with median income ticking up, average prices have gone up, but interest rates are half of what they were, back in 2006. So 21% of your income is going towards mortgages on average across the country. So it does look a lot different than it did in 2006 through 2008. Not just from, like I said, inventory levels, construction, and lending practices, but really what does it look like in terms of median income versus mortgage payment. Okay, let's talk a little bit about interest rates. So I just mentioned to you briefly that, we saw probably the lowest level of 2.625 in the latter part of the pandemic. I know we're still in the middle of the pandemic, but kind of the October, November-ish range. And so this chart kind of highlights what do interest rates look like going back to the early 90s. So as we mentioned in our previous slides, actually, I'm sorry, this slide goes back to, this is a little shorter slide. So this is about 10 years out. But what I want to illustrate for you is that as you're kind of looking at this line, which is the 30-year fixed, you can see we kind of tapped out here in 2013 about 4.5, and in 2018 we actually rose close to about 5% in interest rate. Since 2018, you can see this slide in interest rates. Now, leading into the pandemic, which puts us right about there, that's when we saw the sharp decline in interest rates. Now, in February of 2021, we saw interest rates go up to about a 2-year high where they started getting to that 3.5 level, which we probably think, wow, that's super high. Relatively speaking, across the decade, it's not really that high. It's actually still one of the lowest levels. But now we saw interest rates kind of tick up, and they kind of went up even almost close to that level in October, started to slide down a little bit, and now we've seen kind of this choppy waters in interest rates. Tomorrow, the jobs report will be released, and we'll see what that does towards the interest rate numbers. And so kind of we're keeping an eye on things. What's impacting interest rates today? Well, the potential new variants that is out right now, that's sending a little bit of shockwaves through the stock market. However, the stock market recovered today. Stock market went up over 600 points. So then interest rates got a little bit worse today. We'll see what the jobs report tomorrow does to interest rates. But as kind of a mortgage professional, this is something we're watching on the daily just to make sure that clients are able to maximize their interest rate. A good rule of thumb, if you're kind of as a consumer looking to see where interest rates are at, pay really close attention to the 10-year treasury and what that's doing. The lower that 10-year treasury goes, generally that's going to mirror what interest rates are doing. So the 10-year treasury is below 1.5% right now. I think it finished up around 1.46, somewhere around in that area. And if we can stay below that 1.5 figure, hopefully we'll still keep these interest rates in that low 3% range. Now, the forecast for next year is to see interest rates go closer to the 3.5 to 3.75 range. So as we're preparing for 2022 and maybe beyond, know that you're probably going to be facing a higher interest rate environment, which could impact some of your purchasing power. Okay, one question we'll get multiple questions during consultations, but one kind of the misconception out there is around what makes up interest rate, because a lot of people think that if the average rate is 3.125 today, then that's what I'm going to get. And interest rates aren't is a one size fits all. There's actually several different factors that go into eligibility for interest rates. First of all, it's credit eligibility. If you have a 740 credit score or higher, you're going to be able to take advantage of the lowest interest rates. Loan products also play a role in that. And you're going to learn a little bit more about loan programs in just a second. Conventional loans have different rates versus FHA loans, VA loans, USDA loans. Those all have different type of rate sets. Your loan amount. So depending on what level of loan amount you're at, that can also impact your interest rate. And then of course, down payment. The minimum down payment, which we'll learn in just a bit, is 3%. The more money you put down on your mortgage or your home price, that could potentially impact your interest rate. And then as you learned a little bit earlier, points or discount points, which incur additional costs towards your closing costs, can help also bring down the interest rate. And finally, the term of the loan you get. So the shorter your term is, generally the lower your interest rate will be. Okay, so that's just something to kind of keep in mind. So when you talk to your colleague at work or maybe your family member saying, hey, I got a 2.25% rate, it's not necessarily a 2.25% rate that is maybe a match for you, because it could be when they locked in that interest rate, could be the term that they've done on that particular loan, and could be the loan program that they utilize. So a lot of different factors that play into that. So we just kind of share that information for you. So as you're preparing to buy, you can understand that, interest rates will differ depending on the program and the overall kind of profile that's set up for you. Now, one of the things that we just talked about with interest rates is credit, and credit will impact your borrowing costs. And so it's really important to understand where you're at credit-wise, what's inside of your credit report, and really kind of how can you optimize your credit score to be able to get the best financing available for you. Now, when we look at different loan programs, there's minimum credit scores for each loan program. For an FHA loan, it's a minimum of a 600 credit score. Sometimes we can go as low as a 580 credit score. There's conventional loans that go down to a 620 credit score. And then we have a couple different first-time homebuyer program options. There's the open door program that goes down to a 640 credit score. There's the Cal HFA loan, which we're going to talk a lot about this evening, which is a minimum credit score of 660. Okay. Now, when we look at what's inside a FICO score calculation, and by the way, many of you who are joining us this evening probably have some type of monitoring service with your credit score. So whether you use Credit Karma, Experian, TransUnion, or Equifax, those are all great tools, or they have great consumer tools to maybe help you have visibility to your credit score. Just keep in mind with those tools, they use the credit card model. There's actually 3 different models for credit scoring. So there's the credit card model, there's auto, and there's mortgage. Of course, when you're applying for a home mortgage, we're going to use the mortgage model, of course. And so here's what's in the score calculation. There's kind of 4 key components to score calculation. 15% of credit is how long you've had credit. So the longer your credit file, or the more mature your credit file is, the better potentially your credit score could be. 20% is how long I've had credit in use or new credit. Now, let's just categorize that as new accounts and inquiries. So that's going to be 20% of your score. 30% is going to be how much I owe or credit utilization. We're going to get back to that in just a second. And then 35% is my payment history, how I paid my bills. Generally speaking, if you've had any late payment challenges, they're going to be categorized in 30-day lates, 60-day lates, and 90-day lates. Going back a bit to this in use and new credit. So when we think about credit inquiries, there's 2 different types of inquiries. There's a hard inquiry and a soft inquiry. In the beginning stages with us in working through your consultation, we're going to start with a soft credit pull. So that just allows us to get visibility to your Equifax score, but it does not impact your credit score. Now, a hard inquiry could potentially. Now, with applying for a mortgage, you do have a 30-day window of time from the day one of the first hard inquiry to shop around with as many lenders to do hard inquiries as you want, but it's a 30-day window of time. Now, going over to amount owed or credit utilization. Credit utilization is the aggregate of your credit limits versus the aggregate of your credit balances. So if I have $10,000 on limits and a $5,000 balance, my utilization is 50%. Ideally, if we're running right now at 70 to 80% utilization, we really want to do our best to try to get below 50% utilization. Now, if you've already kind of mastered that and you're doing a really good job controlling your credit card balances, try to get below 10% utilization. That's kind of the optimal level to maximize your credit score. Now, one important point to make here with credit utilization is understanding how the reporting works with the credit bureaus. So your credit balance will get reported out to the credit agencies at the end of your billing cycle. And what that means is, so if I have a billing cycle that ends on the 20th of the month, but my payment's not due till the 4th of the month, you need to know that even though you're paying off your balance on the 4th of the month, the balance that shows on the 20th, so let's say your billing cycle is going to end on 12/20, so December 20th, but your payment's not going to be due till January 4th. So you went and charged up all your holiday shopping on your credit card, right? Now you've accrued maybe a $5,000 balance, and you're like, hey, you know what? I'm good because I'm going to pay it off on January 4th. But the reality is that American Express is going to take that balance and send the data out to the credit agencies on the 20th. So you can artificially have a high level of utilization, even though you're going to be paying it off in January. Okay. So what I would suggest doing is, if you can try to pay off that balance before the 20th, before the data reports out, then you're going to be able to optimize your credit score a little bit better. Some other credit score factors to keep in mind: bankruptcy, short sales, collections, all of those kind of past challenges, those are going to go under payment history. We're going to see how long those will stick with you on your credit report. Account closures, you want to be kind of careful with that. That's just with revolving credit. So if you close out an account, what that does is it pulls out all the great history that you've had on that particular credit card. So let's say I've had a credit card for the last 10 years and I decided to close it out because maybe I opened another account that I like much better, because it has better card benefits. If you close out that credit card, all the history for the last 10 years gets pulled out of the bureau's model. So you want to be careful with that, especially if you have very limited active trade lines beyond that card. And then when applying for a mortgage, we always use the middle credit score for qualifying. So if I'm a single applicant, and let's say I have credit scores of 660, 680, and 700, 680 is going to be my score that's used for qualifying. Now, if my spouse has 720, 740, and 760 on the credit scores, so their middle scores of 740, we still have to go off the lowest middle score between the two applicants. So in this case, we would still use my 680 middle score. Okay. So, when we look at strategically, how do we design financing for clients? And, if we have one applicant that earns the most income and maybe they have the higher credit score, it may make sense just to use that one applicant versus doing a joint applicancy. So we'll have to kind of look at that as part of a consultation for you. Okay, if we've had some past challenges, these are how long those items would stay on your credit report. So credit inquiries, those are hard inquiries. Those would be there 2 years or less. Late payments, collections, judgments, things of that nature. Foreclosures will be on your credit report 7 years or less. Bankruptcies, those are going to be public records. Those will be on the credit report 10 years or less. And then federal debt, like student loans that are in collections, tax liens, those can be on your credit report indefinitely. Just really quick, I want to back up for just a second. If you do have maybe federal student debt that is in collections, you really want to be careful with that, because that can come up on what we call as a CAVERS report. And a CAVERS report reports back to lenders if you do have any federal student delinquent debt. That is applicable for FHA loans. In fact, we had an incident with that this week. And, and this client didn't actually know that they had a delinquent collection with a federal student loan. So just if you've had maybe some past challenges with student loans, you definitely want to kind of make sure that gets resolved. We can certainly help with that during a consultation, but we got to be aware of those items. Speaking of student loans, those are going to be factored into qualifying. So most of us, if we're on this line tonight and we have federal student debt, you're not going to be restarting your payments, I think, until January, so next month. So today on your credit report, they show us a 0 payment. But as a lender, we do have to count a minimum payment for student loans. Generally, as a first-time home buyer, you're going to be either utilizing a conventional loan or an FHA loan. And there's two different kind of interpretations of the calculations for your student loan payments that those programs use. As a conventional loan, let's say I have $75,000 in student loan debt, and I'm on an income-based repayment amount, then we'll use $250. Let's say it's the income-based repayment is $250 per month. That's the payment we'll use for qualifying. Now, if you're not on an income-based repayment amount, and let's say you're back in school, then we default to 1%. for the monthly payment. So ideally, if you're on an income-based repayment amount, we can document that. That's what we're going to use for the qualifying payment. FHA loans are a little bit different. FHA loans, they will default to 0.5% of your outstanding balance. So if you owe $75,000 in student loan debt, then they'll default to $375 as your monthly payment. But if you still have an income-based repayment amount in place and we can document that, then we'll use, let's say it's $250 per month, then that's the amount that we'll use for your qualifying. If you're in forbearance, which all student loans are in forbearance right now, like I said, we're gonna have to still use the monthly payment. If you're back in school and you don't, maybe in deferment, we still have to count a monthly payment for you in qualifying. If your income-based repayment amount is 0, then that's the amount we use for qualifying as well. Any questions?
There's a couple that maybe you can touch on.
Okay.
So one is someone moving from a different state considered a first-time home buyer if they're owning in the other state?
Okay. So we had a question that came in. Are you considered a first-time home buyer if you own in different states? So if you're moving, say, from Texas to California, are you considered a first-time buyer? So the definition of a first-time buyer is someone that hasn't owned in the last 3 years. So even if you've owned in another state and it's been within the last 3 years, then you're not considered a first-time buyer. Now, if that property was a rental property and it wasn't your primary residence and you can show that you've been renting for the last 3 years, then by definition, you're a first-time buyer.
And then someone asked if there is there a different process for purchasing a home via partnership? So they're saying if their parents are handling the mortgage and they put down the down payment.
Okay.
If there's different percentages.
Okay, so this is kind of in the same topic that we're going to be talking about in just a second. But so a question came in: does the process look a little bit different when you're going to purchase within a partnership? And I think it sounds more like parents and child are going to purchase together. So in that case, if you're going to be purchasing with your parents, depends on who's going to take what role. If the parents are going to purchase in their name, then they would be called, and they're not going to live in the house, then they're going to be called a non-occupying buyer. Ideally, you would be both on the application, and then you can provide the down payment or they can. But if they're co-signing, so to speak, to help you with your qualifying, then they would be considered a non-occupying co-signer. So that's kind of how it would look. If I didn't answer your question, what you're looking for, just go ahead and send us a Q&A question back and I'll answer it on there. Okay, let's talk about loan programs. So there's generally kind of 5 core loan programs for home purchasing. There's conventional loans, FHA loans, VA, USDA, and jumbo loans. Primarily for first-time home buyers, we're going to be looking at conventional and FHA loans, but depending on eligibility, we can look at different programs. VA loans are going to be 0 down programs. Those are for our veterans that have served. As you can see here on the slide, you can go $1 million plus with 0 down. So that's a really, it's a lenient program and it has a minimum credit score of 620. USDA loans are going to be restricted by geography. So depending on where you're looking to purchase, there is going to be some restrictions around income, but they do go up to a maximum loan amount of $647,200. Some of our desert cities can potentially qualify for USDA. If you're up here in Northern California, some of the outlying foothill areas can potentially qualify, Central Valley. And then jumbo loans are a loan that basically we would use if we're going to go above, depending on what county you're in. So let's say it's Riverside County, for example. If we finance over $647,200, which by the way is a new conforming limit across the country, then that would be considered a jumbo loan. And that requires 10 to 15% down. Now, jumbo loans and where that starts will differ by county, because if we were in LA County, the maximum loan amount in LA County is $970,800. And that's up from $822,000 where it was in 2021. So for 2022, these are all the new loan amounts that Fannie Mae, Freddie Mac, and FHA have introduced. So let's talk really quick about jumbo loans and just kind of some of the differences. Generally, as you can see, jumbo loans are going to have a higher down payment because with conventional loans, we could put as little as 3% down. but they also have a higher asset requirement. So once you've contributed your down payment, you also need to have what we call as reserves. And reserves can be anywhere between 12 to 18 months of your monthly payment. So if I have a monthly payment of, let's say, $5,000 a month, and I need to show that I have 12 months in reserves, that means I need an additional $60,000 in assets above and beyond my 10 or 15% down payment plus closing costs. And that's where it can be a little tricky at times for first-time home buyers with a jumbo loan. Gift funds are allowed with jumbo loans, which we're going to talk about gift funds in just a little bit, but it's not typical that a first-time buyer is buying with jumbo, but it is an option for you if that's what you're looking for. Let's talk about conventional loans and FHA loans. So conventional loans, as I just mentioned, the maximum loan amount has just been increased to $970,800. And then the conforming limit amount, which is it's going to be applicable for San Bernardino, Riverside County, is $647,200. That's a big deal for those areas. So those of you that are joining us this evening that are looking to buy in those counties, that's up from $548,000. So it's almost $100,000 jump in sales price, and definitely warranted because we're seeing a lot of our buyers starting to go kind of east just due to affordability issues. So up to $647,200, which is a conforming limit. It's a minimum down payment of 3% on a conventional loan. But once we go beyond $647,200, and if we're not in San Bernardino or Riverside County, let's say we're going into Orange County, the maximum loan amount jumps up to $970,800, but the down payment also increases from 3% to 5%. Okay, so that's on a conventional loan. FHA loans, it's a minimum down payment of 3.5%. Maximum loan amount is $647,200. I don't think do we have the FHA? I don't think FHA loan limits are out yet for LA County yet. My sense is they're going to probably be pretty close to the 970 number.
I think that's what it is.
Is it? Okay. Okay, we'll double check on the FHA number because these are just getting published here. We just got some of these numbers this week, so we'll check back with everyone on this. But the minimum down payment on FHA is 3.5%. Now, as you heard or saw earlier, conventional requires a minimum credit score of 620. FHA at 600. FHA can go down to as low as 580. Now, one of the big differences between conventional and FHA is around what we call as mortgage insurance or private mortgage insurance. So you've probably heard about that as a first-time home buyer. PMI or private mortgage insurance on a conventional loan is based upon a few criteria. So it's based upon credit score, amount of down payment, and loan amount. And with conventional mortgage insurance, those premiums will vary. So the more you put down, higher your credit score is, less you finance, the cheaper your mortgage insurance premium is going to be. So when you go on to calculators like Zillow or Redfin, they're not aggregated to show the different credit risks for PMI. So what oftentimes we hear from buyers is they say, "Hey, I calculated my payment on Zillow and it's like $200 and you're higher than you're quoting me." And the reason why is because the mortgage insurance factors are not quite accurate. So we have a really great mobile tool that we'll talk about this evening that it actually matches up the MI levels and it'll make it a little bit more user friendly. But that's conventional mortgage insurance. The other piece with conventional mortgage insurance, it has a cancellation option. So once you reach 2 years in your home or your loan, your original loan, and two years and 22% equity, you can apply to have the mortgage insurance removed on your loan or canceled. Okay, and that'll be based upon the servicer that you have for your loan. Now with FHA loans, we know the down payment is 3.5%. The mortgage insurance is a little bit different. So generally speaking, the mortgage insurance is going to be a rate factor of 0.85%. So whether I have a 620 credit score or I have a 780 credit score, I'm still going to pay the same mortgage insurance premium as an FHA client. But there is two components to FHA mortgage insurance. There's monthly mortgage insurance and there's upfront mortgage insurance. So the monthly mortgage insurance is 0.85% of my overall amount financed. We divide that by 12, and that's how we come up with the mortgage insurance. And then it also has upfront mortgage insurance, which is 1.75% of your loan amount finance. So as you can hear, the FHA loan is going to be a bit more expensive from a mortgage insurance perspective. But at the same time, FHA is much more lenient from an underwriting guidelines perspective, minimum credit score. And so, the question we get is, why would I choose one over the other? It's generally going to be because of credit and maybe some past challenges that we have to kind of work through. Maybe it's a past foreclosure, bankruptcy, maybe a short sale. that may, lead us to choose FHA over conventional. For example, on a bankruptcy situation, if I had a bankruptcy, FHA would allow me to buy again in 2 years versus conventional is going to want 4 years. Or let's say I had a foreclosure, FHA would allow me to buy in 3 to 4 years, conventional is going to be 7 years. So those different factors could play a role in why we go down one path or the other. Ultimately, it's probably going to come back to credit score and kind of what does our overall credit profile look like. Okay, so you've already kind of heard a little bit more about the conforming limits. Here's what they are going into 2022. So we got to update it. But so this is what the numbers will look like going into next year. Again, these are kind of fresh out of Fannie Mae. So we just got these like a couple days ago. So we just try to get them out to you guys as quick as possible. So they'll be effective January 2022 and beyond. And every year Fannie Mae updates these loan limits based upon appreciation, median income levels and whatnot. So that's what we'll be working with as a lending institution.
Couple questions.
Yes.
So one is, what types of loans are DACA recipients eligible for?
Okay, you said DACA, right?
Yep.
Okay, so question came in, what type of loans are DACA eligible? So conventional loans are DACA eligible. So there is some particular guidelines with those, but we do offer those at APM.
And then second one is, my mom added me to the title of her home. I no longer qualify for first-time homebuyer program. Are there any other programs where I don't need to put 20% down?
Okay, so the question is, I was added, or the statement I heard was, I was added to title to my mother's home. Now I'm no longer a first-time home buyer. So that, actually, I got that same question earlier today. So that really just depends. So if you have not occupied that home as your primary residence for the last 3 years, even though you're on that title, that home, maybe you're renting somewhere else, you're actually still considered a first-time home buyer. And so then your minimum down payment is 3%, and then you could potentially be eligible for assistance programs. Now, if you've lived in that house and you also are on title, then you're right, you're not a first-time home buyer. And then the minimum down payment is 5% for conventional, and then still 3.5% for FHA. So hopefully you've been renting somewhere else for the last 3 years, then you could still be eligible for first-time buyer programs. Now, just kind of to add on to that, if you're not the one making the payments on the mortgage you co-signed, in order to exclude that debt from your obligations for qualifying, we just have to show that that person, your mother, I assume, is making the payments for the last 12 months, and then we don't have to include that into the qualifying. Okay, that's a good question. Okay, let's look at just really quickly qualifying income. We're going to just talk briefly about some different scenarios and some of the documentation needed for qualifying. So if I'm a W-2 wage earner, so that means I'm on a base or hourly position, we're generally going to need the last 2 years of taxes and W-2s, pay stubs for the last 30 days, and then we're going to do some type of verification of employment. Now, for self-employed, it'll look a little bit different. We'll still need the last 2 years of tax returns, but it just depends on how your company is constructed, whether it's an LLC, S Corp, C Corp, whatever it might be. We'll need the tax returns, and depends on how much ownership you have. If you're a sole proprietor, then it's just going to be a Schedule C that'll be inside of your 1040 tax returns. And then we would also need profit and loss statements and verifying the business through a license or maybe a CPA letter. So a couple things that come up with income scenarios. One thing is we hear quite a bit is most people think you have to be on your job 2 years to qualify. So that's actually not the case. You have to have at least 2 years work history and or education. So let me kind of run through an example for you. So let's say I graduate in the spring from Long Beach State in my accounting degree, and I haven't even started my job yet, but Deloitte is going to hire me and I'm going to start in July. Because I went 4 years at Long Beach State and I studied in the field that I'm be working in, that 4 years of undergrad actually qualifies for me to meet that 2 year requirement. Or let's say now I'm working at Deloitte and let's say I have been there 6 months. As long as I can show previous work history to be able to match up to that 2 years, then I would be qualifiable. So there's a combination between education and on-the-job experience to be able to get me to the 2 year requirement. So that's a big deal. Now, the other thing that comes up quite often is, especially our clients that are in the medical industry. So if you're working at multiple facilities, let's say in healthcare, and you're working 30 hours at one place and 20 hours at the next, in order to count both streams of income, we do have to show that you've been on those jobs consistently for 2 years. That's if you're more in a part-time status. Now, if you have a 40-hour work week job, but then plus maybe you have a side business that you want to include in your income, we just have to show that you've been doing both sources of income for the last 2 years, and then both would be qualifiable. The self-employment income can be challenging at times for some of our clients, just because most of us want to reduce our tax liability. And so oftentimes business owners will reduce their income through expenses. So that can be challenging from a qualifying perspective, but that's something we can kind of talk through that calculation with you as part of your consultation. Did I miss anything on income? Just want to make sure I didn't. Okay. All right. Okay, sticking with income, I want to kind of talk to you really quick about a calculation called debt to income ratio. And that takes in consideration your gross monthly income versus your monthly obligations. And so what we do is we do a calculation where we take that gross monthly income, and then we look at things like auto payments, credit cards, personal loans, everything that's basically going to report to your credit bureau. And then we kind of compare that with the gross monthly income. We generally don't want the debt to income ratio to exceed 43 to 45% of that monthly income. Okay. Now, the thing with debt to income ratio is not going to be an indicator of affordability. Affordability is going to be based upon us going through the rent versus buying calculator and just better understanding where you feel comfortable from a monthly payment perspective. But debt to income ratio is what lenders will use to determine your qualifying. So ideally, we want to keep the debt to income ratio somewhere in that 33 to 36% ratio level. That's where we see most first-time buyers being comfortable, but eligibility will allow us to go to that 43 to 45% range. Now, here again, what is inside a debt to income ratio? So it's principal and interest, taxes and insurance for your monthly mortgage payment, PMI, which is private mortgage insurance, and then let's say you're buying a townhouse, maybe a condo. We'll have to factor in HOA. So that would push the monthly obligation up to $2,500 per month in this scenario. And then let's say I have a car payment of $500 a month, and that's my monthly debt there. So if I take that $3,000 in debt versus my $8,500 a monthly income, my debt to income ratio would be about 35.29%. And that, like I said, probably be in that 33 to 36% range. Different properties will have different tax rates, like we talked about earlier. So, the newer construction homes, especially like in some of our subdivision or suburban areas, maybe Irvines, things like that, we can see higher tax rates. So those will impact your monthly mortgage payment. And of course, that monthly mortgage payment going up will increase your debt to income ratio. So things we want to look at as we're kind of designing a home buying game plan here for you. All right, we're going to talk a little bit about assets with purchasing your home and kind of really what we need to save and the sources that we can utilize for our home purchase. So generally speaking, the assets that we'll verify will be checking savings accounts. We want to see asset statements for the last 2 months. We want to be able to kind of see the transaction histories to make sure that all the deposits are all sourceable. They can't be any cash deposits, things of that nature. Retirement accounts can potentially be used, 401ks, 403bs, potentially IRAs, but you definitely want to talk to your tax advisor or your financial planner, make sure that's not going to pose any type of tax liability for you if you do access those funds. And then gift funds can also be used. That's when you have a family member that's willing to contribute to your home purchase. And then we just have a kind of a process of paper trailing that, whether it would be like a gift letter, proof of their asset statement, and kind of proof of the transfer of those funds. Now, with assets, like I mentioned earlier, we probably want to be in a position where we're saving, 3% of our down payment, plus we want to carve out maybe 2 to 3% of the purchase price for the closing costs. So on average, if you were using or looking at savings goals, you probably want to have about $20,000 to $30,000 in savings for an average purchase price of about $500,000. Now, for most of our first-time buyers that we work with, that can be a bit of a challenge. And so in partnership with Cal HFA, we have assistance programs that we offer first-time buyers, which can be a great support and resource for you to be able to help maybe make homeownership more of a 2022 goal for you versus maybe being a 2024 goal. And so there's 2 programs available through Cal HFA. One is called the My Home Assistance Program. The other one is the ZIP Assistance Program. My Home allows you to borrow up to 3 or 3.5% of your purchase price, up to a maximum of $15,000 in low interest assistance. It's at 1% interest and it's simple interest. So like if you took out to $15,000 in assistance, it'd only be $150 in interest accrued every year. And it's not going to compound. And that assistance is not required to be paid back until you either sell the home or if you refinance in the future. Okay, so that's my home. So as you can see, it's 3 or 3.5% up to $15,000. So it falls in sync with conventional loans and FHA loans. Now, for the closing cost side of things, there's the ZIP assistance program, and that allows you to borrow up to 2 to 3% of your loan amount in closing cost assistance. It's interest free, and it also has a deferred payment. So when you sell or refinance the home, that's when you would pay back that assistance. Now, if you're in a public school system, K through 12 as an employee or a fire department employee, or maybe you're buying a new home, that maximum of $15,000 goes away. Basically, it's completely waived. So you can go all the way up to the 3 or 3.5% down payment assistance. So let's say I'm buying a $600,000 new construction home in Long Beach, right? Instead of getting $15,000, I would get the full $18,000 to cover my entire 3% down payment.
I have a question you
Sure.
come up with.
Yeah.
If someone refinanced their a home they're renting to get a down payment for a new house, how would that work for down payment?
Okay, so question just came in. Someone asked if I refinance my investment property to access equity and get cash out for my down payment on my new place, how would that work? So if you, in that scenario, that's a secured asset, so you can take that money out to be able to use towards your down payment. Us as the lender, we will qualify you with that new mortgage payment on your investment property, and whatever funds you're using for the new home purchase, we'll build that kind of, home buying game plan there. So whatever amount of money you're going to put down. Now the question is going to be if you qualify for first-time home buyer or not. So depending on if you've, recently left that particular investment property as your primary residence, you convert it from a primary to an investment. But if you haven't lived in that house for the last 3 years, technically you would be considered a first-time buyer for the next purchase.
Can you do both at the same time?
You just would have to make sure. Yeah, you could. So the question, or Ken's question, follow-up question was, can we do it at the same time? And you can do it simultaneously where you're refinancing, taking the money out, and also using it towards your home purchase. So yeah. Okay, kind of getting back to Cal HFA really quick. So here's what the down payment assistance program looks like. So, and how it would be applied in, say, a $500,000 purchase. So let's say traditionally I'm buying a house for $500,000. So as you can see here, I'm probably going to need, between my down payment and my closing costs, I'm going to need about $25,000 to $30,000. And I kind of gave you that number earlier. With the same loan, however, going with Cal HFA assistance, I'd still buy that $500,000 house, but I would get my home assistance of $15,000. So now my entire down payment is covered. So that's good news. And then I can elect to also have 2 to 3% in ZIP assistance. So $9,700 to $14,550 in ZIP assistance. And now instead of having to come out of pocket $25,000 to $30,000, now I could have potentially $24,000 to $29,000 in assistance. And that's used to help offset this cash out of pocket expense. So now again, instead of making this maybe a 2 or 3 year goal, maybe it's a 1 year goal for me to be able to get in position for home ownership. And that's Cal HFA assistance. And with the eligibility for this program, it does require a minimum credit score of 660. There's a maximum debt to income ratio of 45%. And there's income qualifying, but it's based upon the applicants, not the household size. So if you're buying in, let's say, LA County today, the income limit is $158,000. Now, if I'm just applying in just my name, let's say I'm married and my spouse makes $50,000 a year and I make $150,000. So combined, we're over the $158,000 mark. If we use just my income at $150,000, then we could be eligible for the assistance program because we would just be applying in just my name. Okay, so that's an option there. Now the income limits get updated with Cal HFA every June. So in June, my sense is we'll probably see a higher income limit. If you go into more Orange County area, you're looking at about a 220 income limit, which I think we have on the next slide here coming. And then again, as we've talked a few times this evening, which is what's a first-time home buyer? It's again someone that hasn't owned in the last 3 years. Here's the income limits for 2021. Again, these will get raised again for 2022 in the middle of the year, but this is what it looks like in LA County as well as some of the neighboring counties. Okay, so that's the Cal HFA Assistance Program. We also have another program designed for medical professionals. So whether you're you're a medical doctor, maybe you're a dentist, you're a teaching professional, or a licensed medical resident, the medical professionals program, it's basically allows clients to purchase more at that jumbo level, but without the restrictions of reserve requirements and the higher down payment. It does have a minimum credit score of 700 to 720. But it does have the ability to be able to stretch a little bit more on the debt to income ratio. Most jumbo loans have a restriction of 43% on the debt to income ratio. This will go up to 45%. And the reserve funds that are needed for most jumbo loans are a little bit more relaxed. And probably the biggest thing with the medical professionals program is has some flexibility around student loan payments. So all those calculations that we showed you earlier this evening, in some cases, student loan debt is not even counted into the debt to income ratio qualification.
I have a good question.
Yeah.
Can you use Cal HFA and still put more money down to make your down payment?
That's a great question. So a question came in, can you use Cal HFA and still use your down payment you have saved to put more money down? And the answer is absolutely yes. So let's say you've already saved your $30,000, but you also want to add on the $15,000 in down payment assistance and maybe the closing cost assistance to be able to decrease your first mortgage amount, maybe leverage this low interest assistance. You can absolutely do that. So there is no asset restrictions on the Cal HFA program. So whether you have $1,000 saved or $100,000 saved, that doesn't influence the eligibility for the program. Okay, great question.
Are there any programs for state employees with home buying assistance?
So the question is, there any state employee assistance programs? So there isn't anything specific for state employees. We do have our state employee discount program, which is actually the same program for Long Beach State, which we discount our cost by $750, but there's nothing specific to state employees. All right, well, we appreciate the questions coming. Those are great. Let's talk a little bit about the buying process. We call this our 6 steps of home buying. And this kind of is our kind of our roadmap to home ownership. So the first step is pre-approval. And actually, before we even get to pre-approval, we do a consultation with you. And that's where we do a one-on-one over video, or maybe it's a phone call if you prefer that. And we design a home buying game plan. We talk about credit. We look at your application. We design our budget, talk about out-of-pocket expense, interest rates, all that stuff. And those ingredients come together. And then the output of that consultation is to have you pre-approved. A pre-approval certificate is used to present an offer to a seller. And that kind of gets us on the road there. So we'll start with step 1, which is pre-approval certificate. The pre-approval can be adjusted based upon what homes you're seeing on the market. We're going to design that pre-approval to meet your affordability. So let's say I feel really comfortable at $2,500 a month. That's what your pre-approval will be based upon. But maybe you find something that's at $2,300 a month, and that's a much cheaper purchase price. So whatever that case may be, we'll adjust that pre-approval accordingly. Step 2 is going to be house hunting. That's where you get a chance to go out and look at different home options. Generally, your search will start online. And what a great support system or support partner will be a realtor for you. As you heard earlier, realtors are paid for by the seller. So we highly encourage our buyers to use realtors. With realtors being paid for by the seller, if you do decide to go with new construction, you can still elect to have a realtor. That's always an option for you. We have a fantastic database of preferred realtors that we work with across California. So whether you're buying in Ventura, Central Valley, LA, Orange County, Sacramento County, wherever it might be, we have preferred realtors that we work with. So if you need that connection, we're more than happy to make that introduction for you. So step 2 will be house hunting. Now, if we do find a home that we love and we want to make an offer on, the realtor will help us construct the offer and then present that offer to the seller. Now, if the seller accepts your offer, then we move to step 3. That's called entering escrow. So that means we have a ratified contract with the seller and agreement to purchase that home. Generally, the process from acceptance to now getting my keys is going to take about 30 days. Of course, if we're going to buy during the holidays, it might take a little bit longer just because of restrictions with business days, but ultimately it's about 30 days. Now, at enter escrow, you're going to be required to make an earnest money deposit. That deposit is usually like 1 to 2% of your purchase price. Usually it's about 1%. That money is a good faith deposit that is put into what we call the escrow company, and it's held there, and it shows the seller that you basically, it's your good faith deposit. That money is protected for you while you go through what we call is the contingency phase. And the contingency allows you as a buyer to do your due diligence. So you get the house appraised, which us as a lender will order that appraisal. We'll get the house inspected, and your realtor will orchestrate that. And there's a variety of different inspections you can do: home inspections, pest inspections, foundation, sewer, roof, pool, whatever you think you need to do to feel really comfortable about this property. And then finally, this loan contingency, and that's basically when we complete the loan approval and we evaluate credit, income, assets. The pre-approval is kind of, we're going to do some of our review of that at that stage in the game, but the loan approval is actually where an underwriter has actually reviewed all of your profile and rendered a credit decision. That contingency period usually happens in the first 14 to 17 days of your contract period. So the contingency is probably going to take you up to step 5 in the process. And at step 5 is where we'll have to make a decision if we want to move forward or not. Because remember, that contingency is in place to protect you as a buyer. So if for something, something just doesn't look right with inspections, or maybe your loan doesn't get approved, you can cancel the transaction and get a full refund of your deposit. Now, going back a little bit, I want to talk a little bit more about step 3. So within 72 hours of your acceptance of your offer, we'll get together for a follow-up video consultation. And that's where we go through the construction of your financing, talk a little bit about interest rates and where those are at, talk about your out-of-pocket expense, make sure you feel comfortable with it, and kind of lay the groundwork for what's to come ahead in the home buying process. Okay. Now, at every one of these milestones, our compliance group will send disclosures to you, and those will highlight your interest rate, your payment, your out-of-pocket expense, and it should mirror our conversations that we've had earlier in the process. Step 4 includes processing and underwriting. That's the administrative task in the loan process. We order your appraisal, we verify your employment, and then ultimately submit all our documentation to our underwriters, who will issue a loan approval at step 5. Now, as you heard earlier at step 5, we're at the end of our contingency period as well. So as long as we feel comfortable in the process, we'll sign off on those contingencies. And that tells the seller that we've done our homework and we feel good about the property and we want to move forward to the final stages. Now, if you decide to cancel, you got to make sure you do the cancellation within the contingency period, because if you go past the contingency period and then you decide to cancel, then you could lose your entire deposit. So you just want to make sure that you feel really good about that before completing those sign-offs. The last thing that happens at step 5 is we issue a final closing disclosure to you. And that final closing disclosure gives you your final interest rate, payment, out-of-pocket expense, and then starts this 3-day cooling off period before we move to the final stage of step 6 called closing your loan. And at closing of your loan is where you're going to sign final documents. That's going to be done in person with a public notary. That process usually takes about an hour to an hour and a half. Once you've done that physical signing, then you will deposit whatever amount is remaining for your funds to close for your home purchase. After that's completed, the escrow company will upload all of your signed documents to us. We'll complete an audit of your loan just to make sure everything is, all I's are dotted, T's are crossed. And then we'll wire in the funds for your mortgage. And then if you've elected a Cal HFA assistance program, we'll also wire in those funds. The escrow company is responsible for making sure your funds are received, your out-of-pocket funds, as well as your mortgage funds. And then they balance out those numbers to make sure that it matches up to what the seller is supposed to receive in proceeds. If that all looks good, then they'll release documents to the county that you're purchasing in, and they record a grant deed, and that transfers ownership to you. And they also record a deed of trust, which is your agreement to repay the loan. After they receive recording confirmation, then that's at the point where you're the official owner of the property, and now you can high five everybody and celebrate because you've reached the end of the home ownership journey. And now the real fun begins. You get a chance to move in and get all settled into your new house. And so we have several clients doing that this week. So a lot of great things that happen once we get to step 6. So we love to celebrate that huge accomplishment with our buyers. As you heard, before we get to step 1, whoops, got too far ahead. We start with a consultation. And so that's about a 30 to 45 minute session where we get together over video, over phone. And it's a free consultation, so you're not obligated to work with APM, but it just allows us to design a home buying game plan for you. After kind of hearing our workshop content, if you want to kind of sit down over video and go through, a plan for you for buying in the upcoming year. We have the online application link all set up on this slideshow. You can complete an online application, and then we only do a soft credit pull, so it doesn't actually impact your credit score. Then you would just upload documents with income and asset statements. Now, after leaving today's discussion, if you just want to kind of get together for a 10-15 minute quick call just to talk about your scenario, maybe ask or have us answer any follow-up questions, you can sign up for an intro call. So to schedule any one of those appointments, you can just click here on this slide, and that'll get you on our calendar for an upcoming conversation. Here's the framework of a consultation for you. So just so you can understand, we talk about affordability, some goal setting in home ownership. So we have clients that we meet with over consultations that are not buying for about a year, and that's totally okay, because I really believe in goal setting. I mean, we want to be intentional with home ownership. It's something really that's on our radar. We want to make it happen. We got to start setting up a plan. We'll go through affordability, like I said. We'll talk about location of where you're buying. If you do need an introduction to a preferred realtor, we can help do that after the consultation. And then we'll look at interest rates, closing costs, your debt to income ratio. And hopefully we get to a point where once we have the plan designed, we can issue your pre-approval certificate for you. Okay, I mentioned earlier at today's discussion, we have our mobile app. So if you're having some challenges doing some payment calculations and whatnot, you can download our mobile app. It's a fantastic tool. It'll also follow your progress for you in home buying. So it's available on Android and Apple. You can check that out. And if you've enjoyed tonight's content, we teach workshops every couple weeks. We have a variety of different content topics that we'll go through. Here's our upcoming workshop schedule that we have for Q1, a little bit of Q2. And if you want to kind of check our updated dates, go to mortgageeducate.com. In fact, this picture is one of our in-person workshops, and we used to do a lot of those. Most of our stuff is done via Zoom, but we will have some in the Southern California markets, more of a hybrid version. This is all my personal contact information. So if you want to get connected with me after tonight's workshop, feel free to text, email, call, whatever works good for you. And like I said, love to be able to meet up with you for an intro call or even a consultation if you want to help us design those home buying game plans. We have just the great opportunity to help serve you in home ownership, and we love what our clients are saying about us on Google, Yelp, some of our social media testimonials on Instagram or Facebook. In fact, I just talked to one of our workshop graduates earlier today, just purchased their home in LA County, super excited. They're moving in this weekend. And that's what it's all about for us, being able to teach you, give you kind of the tools and resources to home ownership, and then ultimately have you in position to be able to purchase and find that home of your dreams. So hopefully we get a chance to connect with you to be able to help make that happen for you, and you can be another future graduate and future homeowner. So we're going to stick around for a little bit. If we have any more questions, we're going to keep the lines open.
Nothing yet.
Okay, so we're good. We don't have any questions, but feel free to stick around with us. We're gonna. I'm just gonna shut down the video, and then I'll pull it back up as we get some questions coming in.
I just had one.
Oh,
so if something pops up on like a credit check, is that something we help with?
Okay, so the question was, if something pops up on a credit check, is that something we help with? Yeah, absolutely. So part of the consultation is kind of figuring things out for you. So if something comes up like a late that you weren't aware of, or an account that you weren't in the loop on, we'll definitely talk through that. So a consultation is not a pass or fail for home ownership. It's going to be designing a home buying game plan. So if we got to do maybe some action plans from that consultation, we can certainly do that. So you're not, put in a position where you're declined. It's just kind of putting a plan together.
Are there different resources if we're looking for a home out of state, or would these also apply?
So all of these parameters would apply for an out of state purchase. So, however, CalHFA would not apply to the state you're in now, depending on what state you're looking at. So let's say you're going to go into Arizona. Arizona has the Home Plus program for first-time buyers. But maybe contact us offline and we could talk about maybe first-time buyer programs per se. But in terms of kind of the core programs, conventional loans, FHA loans, they will have the same minimum down payment.
Are there any down payment assistance programs for DACA recipients?
So the question is, are there any down payment assistance for DACA recipients? So yes, so CalHFA recognizes DACA recipients. So it's part of the conventional underwriting guidelines.
Another one, if my business isn't quite 2 years old, should I wait before using that income on my loan?
So the question was, if my business isn't quite 2 years reporting, should I wait to use that income? So, we are going to ask for 2 years tax history on that. I don't think it hurts to connect with us and kind of build a game plan for you. We have a lot of self-employed clients that maybe have filed their 2020 taxes. Well, they should have, but they haven't filed their 2021s and they just want to kind of get together a game plan. Probably not a bad idea, considering you'll be filing taxes in the next 2 to 3 months.
Are there any grant programs that don't have to be paid back?
So the question is there any grant programs that don't have to pay back? There is some that are available out there. They're a bit more restrictive. Generally, those are through local municipalities, so like City of LA or City of Riverside, but they're reserved for buyers that generally make less than 80% of the median income. So they're a bit more restrictive. That's something we can certainly talk about if that's something you're interested in, certainly qualify for it.
If I'm self-employed, what's the minimum my income should show on my income taxes?
So the question is, if I'm self-employed, what's the minimum I should show on my taxes for income? So that all depends. So everybody's minimum, whether you're self-employed or W-2 wage earner, that just depends on your obligations, what purchase price you're looking to be at. So that's something we would talk about as through your consultation. So we'll look at what your income looks like. So if I'm self-employed, we're going to take, let's say I'm a Schedule C income, sole proprietor, I'm going to look at your net income, average it over the last 2 years. There's a certain things we can add back in from an expense perspective, like depreciation. But we'll take that versus what your monthly obligations look like.
That's it so far.
Okay. You guys are rattling those questions off of me. Oh, like I was on the hot seat there. And those of you who are still joining us, I will have to say, great questions tonight. Long Beach State hit it out of the park. So you guys did awesome. Love it. Love it. Love it. And hopefully all these questions that are coming up from the larger group are helpful for you in your personal situation. But like if something didn't get answered or asked this evening, we're more than happy to kind of talk about that through your consultation.
Let's see. Are we able to combine down payment assistance programs if we're also with a credit union?
So the question is, are you able to combine down payment assistance programs with a credit union? Unfortunately not. Cal HFA has approved lenders and credit unions aren't approved lenders for Cal HFA. With Cal HFA, the entire loan would have to be done with an approved lender like APM. So we would handle both the first mortgage and the assistance programs because Cal HFA sets all the offered interest rates every day. So based upon when you purchase your home, you'll have a certain rate offering from Cal HFA.
That might be it.
That's it? Okay. Okay, thanks again for the questions this evening. We appreciate you all joining us. And if you do have some follow-up questions, feel free to reach out to us if they didn't get answered this evening. If you have friends, family, maybe some colleagues that would love to join one of our upcoming workshops, you saw our calendar for upcoming year and that'll be updated throughout the year at mortgageeducate.com. So thanks again for joining us. Again, we look forward to connecting with you in the future and have a good evening. Thanks.